Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. All right, hello, and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for the second time my friend, Chad Garcia. Chad is portfolio manager at the Ave Maria Focused Fund. I think, if I remember correctly, co-portfolio manager at another fund. But Chad, great to see you. How's it going?
Third time. This is the third time.
Is it really?
Yeah. Digital Bridge, eDreams, and now.
That's right. And digital. I mean, Chad, you can look at the Ave Maria Focused Fund. It's been a great year, and I know eDreams is still there. But Chad, we got a lot to talk about today. Before we get started, a disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true, but maybe particularly true today because we're going to be talking about a Canadian domiciled security. So people should just remember, not domestic. It's not like we're pitching something in sub-Saharan Africa carries crazy amounts of risk, but international stocks that carries extra complexities, extra risk. So please do your own work, consult a financial advisor and everything. Chad, stock we're going to talk about today is Secure Energy. The ticker is SES. I think they rue the energy piece of that. That might change in the near future, but I'll pause there and toss it over to you. What is Secure Energy and why are they so interesting?
Well, I think you need to go back into the history of Secure Energy Services. And so the company was founded in 2007. It was half an infrastructure waste business. And so infrastructure being oil gathering pipelines. So where if you have an oil well in Western Canada, they would have gathering pipelines that would go to your facilities, and that would transport oil to markets or much larger pipelines or terminals. And then they had a waste component. And so oil production produces wastewater, and that water needs to be treated and processed. Also, if you spill any of the wastewater or spill any oil, you need to clean up what you spill. And so there's some solid waste processing as well. And so that was about half of the business when the business was formed in 2007, and the other half was energy services businesses. It was a small portfolio of energy services companies that were really tied to new drilling activity. And that worked really well for the company. It went public in 2010. The oil prices continued to go up in Canada. The company hit its all-time high as far as trading price, a price that it hasn't yet seen again. And then 2015, the oil prices declined, and about half of their EBITDA at that time was tied to new drilling activities. And a lot of those businesses, the EBITDA went to zero. And so, they got themselves in a bit of distress. They were able to pull through, and I think management looked at themselves and said, well, that was a fun run, but we don't want to live through this again. So how do we change it? And they spent the next decade reshaping the business. They either shuttered or sold a lot of the energy services components of the business and focused more on the recurring revenue, which would be the pipeline and waste component of the business. And so if you look at it today, 30% of their business is pipeline, which is mostly take-or-pay contracts. About 40% of the volume that goes through the pipeline is stuff that's sourced from their waste business. And so as they process wastewater, they can extract oil from that water, and that oil is recycled and taken to market. And then, the remaining 70% is their waste business, of which it's water processing, landfills. They have a small metals recycling business, and they have a specialty chemicals business, and that business is tied to new drilling activity. But the bulk of the waste management business is ongoing production, which is very steady state.
Perfect. That's great. Got a lot to ask you here, but let's start. It's fun because this one has several different angles, especially the financial angles. But let's start with the question I like to start with everyone. Mm-hmm. Market is a competitive place. Everybody's always competing for alpha, looking for it. What are you seeing that you think the market is missing that makes this kind of a risk-adjusted alpha opportunity?
Well, if you go through the history of the company, the GICS code of it has it as an energy services firm. Their name is, as of right now, is Secure Energy Services. Energy service companies trade at 3 to 5 times EBITDA because everybody knows that it's volatile, and when you get into a bad situation, there's nobody, and if you go bankrupt, nobody's going to buy the assets that you have because everybody else is in the same company, right? But waste businesses trade at, if you look at Clean Harbors, which is an industrial energy company, it trades at 14 times EBITDA. If you look at Waste Connections, which is also in this space that Secure is in, they trade at 18 times EBITDA. And so waste is a much different business. And if you look at the research analysts that cover Secure, they're all energy services analysts. They're not waste analysts. Or they picked up a couple new analysts in the last month that are waste focused, but that should change over time. And so I think that for a long time, this company was viewed as an energy services company. Traditional waste investors, probably didn't think to look there. And with the recent transaction of there's a forced divestiture, which we can get into. Waste Connections bought a piece of their business, and now the market is starting to wake up to the fact that you've got this waste business that everybody thinks is an energy services company that today is trading at 9 times EBITDA that really should be trading in the mid-teens.
Let me start with today trading at 9 times, because you threw up, and I completely agree with you. Energy service companies tend to trade at 3 to 5, and I love how you framed it, because what happens is there's no downside protection, because when you go bankrupt, everyone goes bankrupt, and everyone can buy any assets they want for basically free. But you framed it as, hey, this was trading 3 to 5, waste management trade mid to high teens. I think the first thing a lot of people are going to look at are going to say, hey, Chad, Andrew, you guys, they don't know this. We started planning this podcast in late September, and the stock has been on an absolute tear since then, and the multiple's probably gone from 8x to 10x EBITDA. Right. You can correct me if I'm wrong. I'm just using rough numbers off the top of my head. But I think a lot of people are going to look at that and say, hey, it started to get there. Have we missed the train? So I kind of just want to ask that, because that's the first question anyone's going to have when they see a stock up and to the right over 6 weeks.
I think it takes people time to realize what's going on, particularly the large funds that are the traditional waste investors. I know that the company has been having conversations with these investors, particularly after the Waste Connections transaction. A lot of the people that were legacy Waste Connections investors called them to learn more about the business that their company is buying. And while you're looking at it, might as well take a look at Secure as well. So I don't think they've missed the train, but let's go back to the changes that they've had in the last couple years, and then what's coming up. So Secure in 21 bought a company called Trevita, and that gave them 90% of all the wastewater processing capacity in Western Canada, with 10% owned by large integrated companies. The government, 90% you control an industry, but then if you dial down into the different locations, you really have local monopolies. It's just like a landfill, right? So if you look at their water processing capabilities, you draw a circle around it of 60 miles. Anything within that 60 miles you're going to treat, right? And so you have a portfolio of little local monopolies, right? And when they acquired Trevita, they had 90%. They're basically the only independent waste processor in Canada, and then the integrateds had 10% of it. The Competition Bureau in Canada says, well, we need to take a look at this. They sued to undo the transaction, or at least change it in part. The company fought it for a couple of years, and the resolution was the company had to sell 20% of the 90%. So they went from controlling 90% of the capacity down to 70%. And
this is the sale you've mentioned a few times with them selling
that's a sale to Waste Connections. And if you want to look at the capital allocation prowess of the management, they bought this asset for $1.4 billion coming out of COVID. They made 350, 400 million in EBITDA during the time they owned it. They sold it for 1.15 billion a couple years later, and then they kept 70% of the assets. So,
nice trade. That's a pretty damn nice trade, right?
You get 70% of your competitor for free, and you end up controlling 70% of the market. And by the way, that competitor was distressed prior to you buying them, and distressed competitors may make uneconomic decisions in order to bring cash to the door. Maybe they lower the prices so people can ship in outside of the 60, 100-mile radius. And now you sell to Waste Connections, which is a pretty reasonable economic operator.
Just one more on distress. I mean, I've seen these pipeline companies in distress before. It's not just that you might make uneconomic decisions to kind of try to get some cheap revenue in the door to leverage your fixed costs a little bit, but it's also, I'm not crazy familiar with this, but there's the field over there and they call you up and they're like, hey, will you guys spend $10 million to get, a guarantee take or pay $2 million per year for the next 10 years? Like, that's a great IRR. And anyone would do that except a distress company. You say, hey, even if it's a 20% IRR, we're in complete distress. We can't send 10 million out the door. So it's not just on the take the competitor out on the pricing side. It's also, there's generally some pretty low hanging fruit in terms of CapEx when that happens. I don't know if that's here or not, but just throwing that out there.
So, come March, they closed the Waste Connections deal. They had all this cash come in. They had NOLs built up from their prior struggles in the industry. And so a lot of the cash that came in the door was theirs to use. The business got delevered down to, now it's at 0.9 times EBITDA on a leverage ratio. And they had ample cash to do a substantial issuer bid. And so they have their normal course issuer bid, which they're buying back stock every quarter. But when you do something substantial, you just go out and do a tender offer. And so they did that. And if you look today, they've bought back 19% of the company's market cap, this year. And that they'll probably end the year, they'll probably buy back another 2% in Q4. So they'll be above 20% bought back. And while they're doing that, the company, if you look at the growth prospects of a business, so just from the water alone, the water volumes grow about 5% a year. And then you have some solids that go in there. And so once you mix the solids in the mix, let's say their volume growth is about 3%. They think they can get about 5% on price every year. So their same store sales, you take that up to 8% growth. And it's worth noting that the water processing cost is only about 1 to 2% cost of total oil production. And so it's pretty de minimis to their customers. They can probably spend about $100 million a year over the next few years in growth CapEx. That'll add another 5% earnings growth to it. So on an organic basis, they're growing about 13%. Throw in a couple tuck-in M&A here and there, and that gets you about 15% earnings growth. These tuck-ins are doing 4 to 6 times EBITDA, which in my mind, when you're spending that low of an amount, it's almost like organic growth.
Let me ask one quick question, because we mentioned they buy the assets in distress in 2021, and we talk about how nice these assets are, how nice these acquisitions are. But then, I always have this problem when you're saying, hey, we're going to go do tuck-in acquisitions at 4 to 6 times, but we think our core business, it's growing mid to high single digits organically, great cash flow, really nice. I always have this problem, why is somebody selling you at 4 to 6 times on a tuck-in basis if these assets are so nice? So just trying to square that peg.
A lot of the tuck-ins they're doing right now is in the metals space. So they have the metals recycling business. It's highly fragmented, and the industry is changing where the capital costs for these businesses are going up. So, for example, the product is shipped out on rail cars, and you used to be able to lease cars, and so the small businesses would lease rail cars, and now that ability is going away, and so Secure just bought their own fleet of cars. Mm-hmm. So the smaller players aren't able to do that, and plus the logistics matter, and so the scale that if you're a larger scale, you can better handle the logistical complexities of the business, and so it just makes sense that that's going to consolidate over time. But they're not doing anything in their within their, they're not doing tuck-ins within their waste processing because that's already, that's done. It's they integrated them and connections.
Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. A lot of this is coming off of, as you said, it's water coming off of the excess water supply that's coming off of Canadian people drilling, putting that excess water out, and that's what they're getting. So I guess the one other question that's going to jump to people's mind long term is, hey, this sounds great, right? Like if you're drilling for oil, you're going to get rid of this water supply, whether oil prices are 50, 100, 150, 25, you're going to get rid of it. But I guess, and they've got a great chart. I'm looking at their investor deck at slide 7 that shows, hey, oil volumes have gone up in Western Canada over the past 10 years, and they're forecasted to continue to go up. I guess my question is, hey, we're talking about a 15 times EBITDA multiple on this, right? Which implies substantial terminal value. Is there any risk here that 5 years from now, 7 years from now, we're saying, hey, for some reason, Western Canada is drilling a lot less oil? That could be because oil prices are lower. That could be because of regulatory concerns, or it could be because of, the famous concern people have about the Permian. Oh, the shale is turning over, which, the shale, it's getting tougher and tougher, but people just continue to drill down there. So I guess I'm just thinking about the terminal value there. I'll pause there and hear your response.
There are several plays within Western Canada. A lot of the capital that has went into oil development in Canada has been focused on the oil sands. And so there's been an underinvestment with respect to some of the vertical and horizontal plays that Secure serves. And so I think there's a big CapEx cycle coming to exploit it. So I think we're at the earlier days in the Permian. But I had the same concern. I went up to visit the company this summer, and while I was there, I met with Prairie Sky. Prairie Sky owns 70% of all the royalty interest in Western Canada. And so if anybody knows what's going on in the market.
I'm actually just laughing because if there's a royalty play, Chad has looked at it. Chad has talked to them. Chad has done it. Because I know we've talked. We own a
little bit of Prairie Sky. But so I mean, we own my TPL is the biggest position of my firm-wide, and if you put Secure together with Prairie Sky, you get it like you can kind of replicate a TPL, I guess. But I asked them the same question, and they said at current technology, they have 45, 50 years worth of oil inventory at current technology, and the technology gets more advanced and more oil is recoverable. I mean, I think if you look at some of the deals that were happening in the Permian, some of the larger transactions, I think people were underwriting like 5% of recovery of the minerals, and maybe they can take that to 10%. And so there's a lot of minerals even within the Permian that is not being recovered given current technology, and then as technology advances, maybe you get a little bit more.
Perfect.
But Prairie Sky said 45, 50 years. I said, okay, that's terminal value enough for me. So
I like that. Yeah, I don't. Well, maybe we'll be on the tail end of our careers at 45, 50 years. But yeah, terminal value will be someone else's question to worry about at that point. Mm-hmm. Let's talk capital allocation here. So I was reading the Q3 call, which obviously happened after we scheduled the podcast, but before we recorded the podcast. And the thing that made my eyes jump out is I think an analyst says, hey, your leverage target is 2x. Like, what's your plan? And they said, well, our leverage target is 2 to 2.5x. You guys can do the math. We are levered 1 times right now. And we're going to do 2 things. We think as Chad is saying, we think we trade for a below peer multiple. So we're going to keep buying back stock. But they also say, hey, we want to continue to buy inorganically, as you said, with the tuck-in acquisitions. So I guess I just want to ask 2 lines on that capital allocation. spike the football or anything, because I love that capital allocation thing. But let's talk about share repurchases going forward after they bought back 20%. And then I do want to dive a little bit further into the M&A opportunities.
Yeah. Well, I think they said that they could fund their dividend, which right now is above 3% dividend yield.
I love the analysts who just keep being like, when are we going to raise the dividend? When are we going to raise the dividend? The company's like, hey, we're trading at 8 times EBITDA, like double-digit implied free cash flow yield. We're probably going to buy back shares, and the dividend will just be a little cherry on top for the shareholders.
I told them in March that they should cut their dividend to 1.5% dividend yield to get it in line with Waste Connections and some of the other waste companies, and they said they would just double the stock price to get the dividend yield down. That's what management said.
They've basically done it at this point.
But no, he said that he could fund the dividend yield, he could fund their normal course issuer bid, and they can fund their organic growth capex and their M&A needs. I don't think they're going to have to raise capital for the tuck-ins that they're doing. And by the way, that $100 million of growth capex. Their customers come to them and say, will you add on to this area as you pointed out, and the cash on cash returns that they're getting is probably a 20% cash on cash return for the pipeline and a 25% for the waste business, and so they're getting great returns from this capital that they're redeploying back in their business. But they said that they could fund that with their internally generated cash, and so. You do that. Where does that leave you with respect to levering up a bit? And so, if I was management, here's what I would do. I mean, you've had this period where you've been introduced to a new shareholder base. The large funds that have historically invested in waste companies. They're changing their name, which should take effect on the 1st of the year. The GICS code's probably in process. They've attracted 2 new sell-side analysts that are waste analysts. They're probably going to leverage those 2 new initiations with their current analyst base and go to the banks and say, hey, you're covering me you have the wrong guy covering me. That was appropriate in the past, not anymore. Switch me over to your waste guy. You may pick up some more waste analyst coverage.
Can I pause you on that?
Yeah.
I've definitely had this before where a company's covered by, in my opinion, the wrong people, right? Here you've got energy people covering them, energy services and waste services. And as you laid out, the energy service guys trade for 5, the waste services trade for 15. But if I was just going to push back on a market efficiency argument, I'd say, hey, does sell-side research, does it matter that much that they're getting covered by energy services guys instead of waste services guys? Because they can go to the energy services guys and lay out the same math, right? They can say, hey, look, we're 70% waste. You guys cover 1 or 2 things that have higher multiple businesses than, just owning old drillers. So I guess it is a nice story to sell, but does that really impact market efficiency? Does that really depress the valuation here?
I don't know. I read some sell-side research, but not too much. We do all our own work.
I'm the same. That's why I wonder, because I'm pretty dismissive of sell side, but I make the same argument too. I'll be like, this company deserves to trade for a gold multiple, but it's trading for bronze because these dumb sell-siders are the wrong people. But
when the market's not efficient and your stock price isn't trading where it's at, then you can take steps to fix that. And so, I would, if I were them, I would give new investors some time to do some work on the business. Get them out there. They didn't have an analyst day this summer, but they did have a site tour. Give them some time to get some work, give them some time to get in, and then see what happens. And come Q1, if the stock hasn't materially re-rated. Now, if you look at, we talked about the waste companies trading 14 to 18 times EBITDA, but the pipeline businesses that they compete with too trade at 10 to 12 times. So they're at 9 times today. So they're beneath both. My next step would be to lever up to 2.5 times and go buy 15% of the company back.
I love it. I do love that.
I think they're kind of leading you that's what they said in the call. I mean, I haven't spoken to them specifically about that, but he's like, we're not going to increase our dividend. Our stock is undervalued. We have all the cash we need internally to fund growth, and we're 1.6 times the leverage beneath our our target leverage ratio, and our stock is really cheap. So
let me ask you a leading/softball question. The company was hugely aggressive buying back the stock under 10, right? In the single digits. Great for them. They've made a great return. Hopefully they make a great return going forward. I've definitely had management teams who will show me some of the parts and the stock's at 10 and they'll be like, some of the parts stocks worth 30. We're going to buy back stock till the cows go home. And they start, and then the stock goes to 15 or the stock goes to 20. And they're like, hey, why aren't we buying back shares? And they'll say, oh, we want to be opportunistic. Just like investors do, they'll wed themselves to a prior price. And here it could be even worse because, you can get locked up as a corporation. You can get locked up. And if you set your 10b5 automatic repurchase plan at up to 12 and then the stock goes to 15, even if you want to, you might not be able to. So my question to you is, do you think the stock's run 70% since the last earnings call? Do you think they're going to be as aggressive going forward? Or do you worry, A, they lay off just because they get married to share price, or B, they might honestly look and say, hey, when the stock was at 8, this was the best opportunity. Now that the stock's at 10 times EBITDA, it's too cheap, but maybe we focus a little bit more on tuck-in acquisitions that we think generate a better IRR.
I think they're working really hard on tuck-in acquisitions. I just don't think that it's going to, I think tuck-in acquisitions moves the growth 2 to 3% a year. I don't think there's really anything they can do that's upsize. And if you want to look at the waste business, they're not getting any bigger via acquisition. They've already attracted the attention of the Competition Bureau. The opportunity there would be to go out of basin, but I think you kind of lose some expertise and some knowledge, and that might be hard to do. Are they going to come down to the Permian and go after assets there? Probably not. They don't have the expertise or the network there. So I think that leaves them to grow internally, grow via acquisitions, some of their non energy waste businesses, and that's it. So where's the cash going to go, right?
You made a great point. The waste processing business, they just cannot do in-basin M&A there, right? Like that is decided by the competition authority unless things dramatically changed.
Yeah, I think you grow it organically.
Yeah, absolutely. But there's only so much. It's one of those things you wish you could write a $500 million organic check into that every year. You simply cannot, right? You're talking 30 million, 50 million of organic capex or something every year.
I think the 100 growth capex that they're spending is going to be split between that and their pipeline business, probably.
Exactly. But there's just a limit to that. So where I was going is the tuck-in acquisitions going forward, it seems like it's going to be focused on the metal recycling business, right? And my other question would be, in my mind, you know the company better than me. I've spent, on and off a day and a half, 2 days on it. The metal recycling business, when I look at it, it doesn't share to me a lot of those great, a lot of the great characteristics that the pipeline and the water business do. So I guess I wanted to ask you, am I right that the metal recycling business is likely where the inorganic growth comes forward? And am I wrong to think, hey, that's probably a lot lower multiple. It's not as sexy a story as the rest of it.
Yeah, it's probably not as sexy, but they're picking us up for 4 to 6 times and they're extracting synergies. And Truvita had a metals portion of it too that they picked up. And if they increased the inventory turns, and inventory turns really drives the economics of that business, they increased it 10x. It was like 1.2 times in Truvita, and it's 12 times turning now. And so
How'd they increase I'm just trying to get an understanding of the synergies. How'd they increase the inventory turn so much?
Oh, I just think it was poorly managed. So
okay.
A lot of do things better, blocking and tackling. Truvita's financial issues probably had attention focused elsewhere.
Yep, that makes total sense. And you think going forward, future acquisitions, because again, correct me if I'm wrong, it seems like that's where the acquisitions are coming from. You think there'll be similar kind of opportunities for self-help in future deals?
Probably. When you're buying something, it's family run, small business, and you bring real capital and professional management to it, I think you get an uplift.
On the water side, I had a lot of people ask questions about, hey, there's worry these guys own so much in the water basins. Yes, it is a small piece of the cost of extracting oil, but they're getting great ROEs, great returns on these. I had a lot of people ask questions, hey, what about customer insourcing potential here? If you're a major player, you're drilling, you look at to say, why don't I build my own infrastructure and kind of make that 20% plus return for myself?
I think that when the solids are separated from the water, they have to go somewhere, and they go to a landfill. And I think to get a landfill permitted, first you need the right geographic formation. It has to look like kind of a bathtub where the liquids will flow down to one small point that can be plugged at the bottom.
Mm-hmm.
But you have some geographic constraints on an industrial landfill, and then the regulatory process is huge. I mean, that's a
fantastic answer, but it's not just for the people who are thinking, oh, the oil site drill for oil, you take the water and separate it out. It's not just getting that permitted. You actually need to have a landfill on the back end, and because Secure controls the pipeline to the landfill or the landfill itself, it's not for someone thinking to insource. It's not just building that pipe. You have to get the landfill access, build the landfill, and everything, and that is just going to be a no-go for just about everyone.
And why would you? And then you throw up a landfill. Now you have a competing business, and so now knives come out because you might have two competing landfills.
Also, one of the nice things with landfill pipelines, all these things, let's just hypothetically say there are 5 big buyers in a market, right? Mm-hmm. If you can spread the fixed cost of the landfill, the pipeline, and everything over those 5 buyers. So even if you're charging them a large premium, because you spread it over 5 buyers, they all get a better deal than if they went to insource and do it all themselves. Now, I guess you could say maybe 3 of the 5 could combine, but what 3 of 5 competitors are going to do this? It's just a very moaty, protected business. You can tell me if you want to add anything or disagree on any of that.
No, I think you got it.
Perfect. Waste processing facilities. I think they say they're operating at 60 to 65% utilization. How long does it take for them to kind of grow with customer demand and get that closer to 80, 85, 90%, where maybe they think about doing a new facility, or, at 80, 90%, you're leveraging your fixed costs much harder?
Yeah, I think the utilization is at landfill, is the landfill 6% utilized. And so What they're saying is that they have a lot of life left in them.
Yep.
But you can always, it's hard to get a landfill permitted, but it's easier to tack on new cells to the existing landfill. And that's part of their maintenance CapEx. And so part of their ongoing expense is developing new cells within the existing landfills.
Gotcha.
I just think they're saying, listen, we have plenty of room left to grow.
And man, landfills, it's crazy that one of the best businesses I'm aware of is literally the trash business, landfills. And I know you know a lot about these businesses.
Yeah, let's take a deeper dive into this.
Yeah.
Waste businesses have made investors a lot of money for a long time. But if you look at the returns on capital, they're actually low. The trick is that they grow. So they're trending in the right direction. And why is it that the returns are low? Well, first off, you have the big fixed cost of building a landfill, so that's that gets recognized over time. But you have the asset, you have to really put the asset in place up front. But the other part is collection of the garbage. I mean, municipal waste companies have whole fleets of heavy equipment that has a very limited life that they have to constantly replace, which drives down the returns. Here, with the water that's coming from the fracking, it either comes on a pipeline, but most of it comes via tanker trucks that's owned by their customers. And so they eliminated the whole capital, most of the capital expense of the collection of the waste.
That's great. No, it's an incredible business. Why do you think? This is a weird question to ask, but this is a really good business. And you and I, we have some investors we know in common. We know some others. Waste businesses, like the strength of them is not unknown to investors, right? Like there are a lot of compounder bros who have 20% positions in things that are waste or waste adjacent. I guess you're kind of the only person I've heard talking about secure, not to toot your horn for you, but why do you think a lot of our mutual friends or a lot of other, people who are really familiar with waste businesses, you said when Waste Management bought the 20% of the business, you got some inbounds, but why do you think people haven't picked up on this story so far?
Well, when I first started looking at waste, I started first with Waste Connections, which is a fantastic business. And at the time they owned about 5% of their business was in the Permian doing stuff like this, but it was small. So, why even spend too much time on it? And if you look at like what was great about their business on the municipal side, they had on the West Coast, 45% of their business was a monopoly where the government gave them a franchise, and then everywhere else in the country they had they were the largest player in a small market, which gave them the low cost moat, because if you're a large player, you have the best utilization. So there's so much interesting stuff going on in the waste companies, and Connections was really the only one doing too much in the energy spot of it, and was small. So I think people just kind of ignored it. And I think now with Connections buying the secure assets, and that's going to open up a lot of people's eyes to it. And they're talking every time they have a conference call, they talk about how great the deal was for them, how great the assets are, how it's outperforming. In the last call, they talked about how the regulatory environment for municipal deals is getting tougher, and that they think that their competitors are going to start looking outside of the municipal space to do M&A, just because the regulatory regime is easier to get deals through.
A question that just helps me. We talked about how the 2021 acquisition that they did, that they end up having to divest 20% or so of. We talked about how great it was, right? And you mentioned, hey, they bought a player in distress. And I think a little bit of that distress was COVID driven. But I guess if I'm listening to this podcast with a critical ear, one question I would have is, hey, Chad, you're talking about how great these assets are, consistent, high returns on capital, all this sort of stuff. They bought a lot of these assets in distress. So what happens that drives those assets in distress that's not a risk here?
I think Trivita was resulted from a merger of two companies that were both kind of over-levered at the time. If you look at the biggest shareholder in Secure right now, it's Angelo Gordon. They got in through the distressed debt in Trivita. And so Trivita had done an acquisition. They over-levered to do it. You had COVID hit. I mean, I don't think there's too much risk with energy prices moving the volumes here. But if you get into a situation where the world's shut down, then oil's not going to flow, and you're going to have and that's what happened there.
I do hear you though, and maybe they're playing games with it, but even in 2000, the difference, if you kind of look at their charts, this is for people who are looking at their October investor day relations. It's slide 7. Waste oil volumes go from like just over 4 billion to 4, I think that's million barrels per day, to just under 4. Like, it actually doesn't drop that much during COVID in 2020. So they flow better than you expect, but that was also kind of a blip. These businesses, when I look at this, obviously I think waste and landfills belong nicely together. But when I look at metal recycling, which we said might be the future of inorganic growth here, I kind of look at that and wonder, does that belong with the rest of the businesses, or how much do all these businesses belong together? Because they have been separate before. Is there a separation argument?
I mean, it's 10% of the 70%. So it's right. And so if I would think that if I was looking to divest something and do some financial engineering, the one that makes more sense to me from the perspective of getting the appropriate valuation for the waste business would be the pipeline business, because the pipeline business obfuscates the true financials of the business. So Secure screens poorly. They don't take any price risk on the oil, but they're forced to have the oil pass through at as a sale, and so their revenue is artificially higher than it.
Is that so? Oil's 100. They make $1 per barrel no matter what, but oil's 100. They have to pass it through at 100. Oil's 50. They have to pass it through at 50. So it looks like 1 year their revenue's down 50%. The next year it's doubled. Am I thinking about that correctly?
Yeah, and it looks like their margins are horrible. It looks like their revenue is more volatile than it is, and so it just screens horribly. And you have to dig into the MDA and kind of model that out in a spreadsheet yourself to start to get comfortable with it. But I could see them selling off the pipeline business. Now they're 40% of the volume, but you can just deal with that with the contract. Okay, we're going to sell you the pipeline, but we're going to be a big supplier. Here's our 20-year contract, and let's go. And then we'll take that cash. And I mean, 30% of EBITDA, so they're 500 million of EBITDA, so that's 150. You get 10 to 12 times for that in the pipeline business. That's a hell of a lot of money to buy back stock with.
Yep. And I mean, as you said, it is certainly not unheard of in the world of financial engineering because pipelines are such a mission critical, stable business unless your supplier literally goes hell. Every MLP in the United States was basically built on, hey, we take the pipelines out of the contractor, put them on a 10-year contract, fixed costs, and
the pipelines are about 40% take or pay contracts too.
Yeah.
So it's very, very stable.
Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. I think we've covered a lot here. Last question for me, and then I'll turn it over to you in case we didn't hit anything. But I mentioned a few ways, but one question I always like to look at is, hey, Chad, you and I are sitting here 5 years from now, right? We're on our 14th podcast. And I'm saying, hey, Chad, that one you pitched back at the end of 2024, Secure Energy, it didn't work for some reason. Maybe it's down 90%, maybe it's down 9%, who knows, but it didn't work. What keeps you up most at night that worries you about this company? Or why do you think that kind of it didn't work 5 years from now scenario would have played out?
I mean, operationally, they're dealing with some hazardous materials. They have some operations that where people can get injured. I mean, there's definitely maybe a pipeline breaks or you have an environmental concern, you get secured. There could be some anti-oil regulatory regime in Canada, but the Trudeau's in there now, so I don't think it's any worse than that.
That's kind of why I didn't even ask it. I was like, I don't know how much worse it could get up there.
But I asked the same question to the CEO, and the CEO he's been with the company for since its founding, but he has recently been the president and just took over as the CEO this year. The legacy CEO who founded the business is the vice chairman, stayed on the board, and he developed the CEO. But I think the newer CEO is young and he sees all the growth opportunities and he wants to take the company to the next level. And the first risk on his mind would be a safety concern, because of his people. And the second is that he's not going to have the time to realize his vision because, as people recognize how great this asset is. I mean, when I was at the Raymond James large conference that they have in March, it was as the Connections deal was about ready to close. I sat in the GFL breakout session. People asked if they participated in the bids for the assets that Connections got, and Patrick DeViggy said, yes, these are great assets. And if I would have bought them, I would have been pillared, but Connections bought them, and now they're heroes. And I think he was talking more about the concerns that people have had for the leverage in his business, which is probably why he wasn't that aggressive in buying it, but he certainly recognized the quality of the assets. And then if you look at what's happening to his business subsequently, he's selling off his environmental services business, which is a liquids business. It's a different type of liquids business than what Secure is, but it's a liquids-based business that geographically overlaps and is ran by a former Secure employee. And that business is up for sale right now. The rumor price is around 15 times EBITDA, which would be another good comp for Secure. But if that gets taken out by a large infrastructure fund or somebody without any issue getting another deal done through the Canadian Competition Bureau, I mean, why wouldn't you just look at Secure next?
Great. We have covered a lot here. Is there anything we didn't hit on Secure that you think we should be hitting, or anything you think we should hit harder?
I think 3% dividend yield, 7.5% free cash flow yield, growing at 15%.
Buying back 20% of their stock.
Buy back 20% of stock. Potential to buy back another 15 to 20% in 6 months. I think we covered it.
Perfect. Well, Chad, this has been great. I'm happy to have you on for podcast number 3, Ave Maria Focused Fund, AVAEX. Am I remembering that correctly? AVEAX. Yeah. I look at the fact sheet every month and say, oh no, it's still the same big holdings. But anytime a new holding pops up, I like to steal it because LandBridge. Completely different story, but I mentioned Chad is involved in every royalty play, seemingly. LandBridge, it IPO'd, and I think I first saw it. I missed the IPO. I think I first saw it when it was like a 1.5% position. I was like, oh, what's a new position doing on there? And that has just been a killer.
Not a 1.5% position anymore.
No, it's not. Well, yeah, because the stock is up, like 150% in 6 months since IPO?
It IPO'd June 28th, and it's up over 4x.
It's unbelievable.
But LandBridge has an affiliated business called WaterBridge.
Mm-hmm.
WaterBridge is the secure in the Permian Basin.
There you go.
And that company should IPO this coming summer, which would, and I imagine it's going to get a lot of attention given the success of LandBridge, which is going to be yet again another good comp for secure.
Perfect.
Hopefully it doesn't take till the summer for this to keep us.
When you're coming up, I guess you're coming up for the RBC conference again next year, since these guys will be there. We'll meet at where did we go last time? Like one of the places. We'll grab a tea, we'll grab a Greek yogurt and all that. But Chad, it was great. All right. Thanks for coming on for the 3rd time, and we will chat soon.
Talk to you later.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.